Written representations constitute an important element of audit evidence obtained during the completion stage of an audit engagement. Under ISA 580 written representations, auditors are required to obtain written confirmation from management and, where appropriate, those charged with governance, acknowledging their responsibilities for the preparation of the financial statements and confirming specific matters relevant to the audit. Written representations complement other audit procedures by documenting management's assertions regarding matters that may not be fully supported by independent documentary evidence. Although they provide useful evidence, written representations do not replace the need for substantive audit procedures and should always be evaluated alongside other evidence obtained throughout the audit. Their primary purpose is to reinforce management accountability while providing additional support for the auditor's conclusions before the audit opinion is issued. The principal purpose of obtaining written representations is to confirm management's responsibility for the preparation and fair presentation of the financial statements in accordance with the applicable financial reporting framework and to acknowledge that all relevant information has been made available to the auditor. Written representations also reduce the possibility of misunderstanding between management and the auditor by documenting significant assertions and explanations provided during the engagement. They provide evidence that management has fulfilled its obligations regarding internal control, disclosure of information, and cooperation with the audit process. Furthermore, they strengthen the auditor's legal position by providing formal written acknowledgement of management's responsibilities should disputes arise after the audit has been completed. The procedure for obtaining written representations is governed by ISA 580 and normally occurs near the completion of the audit, immediately before the date of the auditor's report. The representation letter is prepared on the entity's official letterhead and addressed to the external auditor. It should be signed by members of management with appropriate responsibility and authority, typically the Chief Executive Officer and Chief Financial Officer or equivalent senior officers responsible for financial reporting. The letter should be dated as close as possible to the auditor's report date because it confirms management's representations up to that point. If significant events occur between the date of the representation letter and the auditor's report, updated representations may be required to ensure that the evidence remains current and relevant. Written representations cover both general and specific matters relevant to the audit engagement. General representations normally confirm that management has fulfilled its responsibility for preparing financial statements, maintaining adequate accounting records, establishing effective internal controls, and providing unrestricted access to all relevant documentation and information requested by the auditor. Management also confirms that all transactions have been properly recorded, that the financial statements comply with the applicable reporting framework, and that all known fraud, suspected fraud, litigation, related party transactions, and subsequent events requiring disclosure have been communicated to the auditor. These representations reinforce the auditor's understanding of management's responsibilities and support conclusions reached through other audit procedures. Despite their importance, the quality and reliability of written representations are generally considered lower than many other forms of audit evidence because they originate from management, whose interests may not always align with those of financial statement users. Unlike external confirmations or independently generated documentary evidence, written representations are internally produced and may be subject to bias, intentional misstatement, or omission. Consequently, ISA 580 emphasizes that written representations alone do not provide sufficient appropriate audit evidence for matters that can reasonably be supported through other procedures. Auditors should therefore corroborate management representations with external confirmations, inspection of documentation, analytical procedures, recalculations, or other substantive testing whenever possible. Professional skepticism remains essential when evaluating representations that appear inconsistent with other audit evidence. The reliability of written representations depends largely on the integrity and competence of management together with the consistency of those representations with evidence obtained from independent sources. Where management has demonstrated honesty, effective governance, and transparent cooperation throughout the audit, written representations may provide useful supplementary evidence supporting audit conclusions. Conversely, where significant inconsistencies, fraud indicators, or limitations on audit scope exist, auditors should question the reliability of management representations and perform additional procedures to obtain alternative evidence. If representations conflict with other audit evidence, the auditor should investigate the reasons for the inconsistency and determine whether the financial statements may contain material misstatements requiring correction or disclosure. There are several circumstances in which written representations are necessary because alternative evidence may be unavailable or impractical to obtain. Accounting estimates involving significant judgment, such as impairment assessments, provisions for litigation, expected credit losses, warranty obligations, and going concern forecasts, frequently require written confirmation of management assumptions and intentions. Representations are also necessary regarding management's plans affecting asset valuation, intentions relating to refinancing arrangements, completeness of contingent liabilities, disclosure of related party transactions, compliance with laws and regulations, and identification of subsequent events occurring after the reporting date. In these situations, management's intentions or expectations cannot always be verified independently and therefore require formal written confirmation as supplementary audit evidence. Written representations are commonly obtained regarding a wide range of specific matters relevant to the financial statements. These include confirmation that all liabilities have been recorded, all known litigation and claims have been disclosed, inventory ownership is correctly stated, related party relationships and transactions have been fully identified, fraud involving management or employees has been disclosed, contractual commitments have been reported, and events occurring after the reporting date requiring adjustment or disclosure have been appropriately reflected in the financial statements. Management may also confirm the completeness of minutes, legal correspondence, and information provided during the audit together with the absence of undisclosed side agreements or arrangements affecting reported balances. If management refuses to provide written representations requested by the auditor, this constitutes a significant limitation on audit evidence and raises concerns regarding management integrity and cooperation. The auditor should discuss the refusal with those charged with governance, evaluate its implications for the audit, and consider whether additional procedures can obtain sufficient appropriate evidence. In many circumstances, refusal to provide necessary written representations may lead to a qualified opinion or disclaimer of opinion because the auditor has been unable to obtain sufficient appropriate audit evidence. Accordingly, written representations play an important role in audit completion by supporting management accountability, supplementing other audit evidence, and contributing to the auditor's overall assessment of whether the financial statements present a true and fair view in accordance with the applicable financial reporting framework.